Debt recycling is my favourite strategy, and I'd say one of Australia's best tax strategies. So in this video, I'll help you understand why. So first of all, it only works and it's only really relevant to you if you meet two conditions. So the first condition is that you have a home and you have a mortgage against that home that you're paying off. And the second condition is that you have cash and you want to invest that cash into shares or into an investment property. So if you meet both of those conditions, or you might at some point in the future, you might want to keep watching because I find debt recycling is quite often a no-brainer. The phrase debt recycling is often thrown around a lot now and it can be a little bit confusing, but debt recycling is effectively turning your non-deductible debt or bad debt into deductible debt that you get a tax deduction for, or good debt. But before I explain how it works, first I'll show how much tax you could potentially save.
So here's a copy of my debt recycling worksheet. So let's say that this person earns $150,000. They don't have a spouse and they're saving $10,000 each year and they want to invest that $10,000. Let's say that their house is worth $1 million and the important figure is that they have $100,000 and that's in cash or potentially in an offset account and they want to invest that $100,000. In this situation, I won't put in an existing share portfolio, but if somebody does have an existing ETF or share portfolio that might have capital gains on it, sometimes it can actually make sense to sell that down, but I'll cover that in more depth in a future video. So now coming down here, let's say that the home loan's worth $500,000. That should be all the inputs. So now if we just head over here, I've kind of pre-highlighted a couple of cells already. We can see in year one, there's a benefit of $2,218. So that's just by the tax savings. And then each year you get kind of those benefits and they compound over time. So you can see over 20 years, there's actually a benefit of $145,000.
So in finance, there's an ironclad law with the relationship between risk and return. But debt recycling is one of the few instances where the law of risk and return is broken and your return is higher and the risk is lower. This is purely because of the tax savings and improved cash flow by structuring smartly. So there's two ways you can debt recycle: using cash or using equity. First, we'll cover off the more simpler option, and that's using cash. So using that example from before, let's say you have a $500,000 mortgage and you have $100,000 in cash that you're looking to invest. So this cash could just be in a bank or a savings account or potentially an offset account, or it could be just cash that you're expecting. So you might be selling down a share portfolio or something, but just important on that note, just to consider capital gains tax implications potentially. So here's how you could debt recycle. So first you split the loan. So you now have two loans, a $400,000 loan and a $100,000 loan. Step two, you use the $100,000 in cash to pay off the $100,000 loan, but you might need to pay it down to $100 or $1, but just check with your bank or broker just to make sure that when you pay that down, they don't just close the loan. So step three, you redraw that $100,000 or whatever amount you paid down and you put that into your share brokerage account. And step four, you invest that $100,000 into a diversified share portfolio or wherever you want where it's going to generate an income stream. So the interest on that $100,000 loan is now tax deductible because we used it to invest in income producing assets. So to recap, you split the loan and then you use the cash to pay down that bad debt and redraw the good debt. You use the good debt to invest in shares and then the shares pay you dividends. So once you save up enough cash from your dividends and salary throughout the year, you go back to step one and do another round of debt recycling. So this is kind of where the term recycling comes into it. You continue repeating this process until you've converted the entire mortgage from bad debt into good debt. So your $500,000 of bad debt would eventually be replaced with $500,000 of good debt. This is debt recycling optimized, but you can choose to debt recycle and invest a lower amount if you like. The benefit is still just as powerful and it's still a no-brainer. So that's how you debt recycle using cash, and that's the simpler option. And another way to do it, which is a little bit more complex, but I'd say often the more accurate way, and that's using equity. And just to recap, equity is the amount of wealth that you have in your home. So if you have a $1 million home and you have $500,000 of debt against that, you have $500,000 of equity. The bank won't let you access all of that $500,000. They'll generally only let you access up to 80%. So it's important to note that I'm not talking about using equity to borrow to invest. That can be a valid strategy, but it's not debt recycling, although I do find online it can be confused with debt recycling sometimes. So debt recycling, you're not actually borrowing more than you would otherwise. So the main purpose of using equity and structuring in this way, rather than the simpler way with cash, is to kind of future-proof in the event your current home ever became an investment property. So I'd say there's no downside of structuring in this way, other than it might be a little bit harder to go through the application from a life admin point of view. but it could just future-proof yourself. But if you're 100% certain, saying no, we'll definitely sell on to that next property, you could actually consider that previous example with cash and there wouldn't be anything lost. So continuing with the above example, let's say you have $500,000 of debt and you still have that $100,000 of cash. So this cash is in your offset account, so you effectively have $400,000 of net non-deductible debt. I also assume in this situation that your property value and serviceability allows you to access that $100,000 of equity. So here's how you could debt recycle. So number one, you maintain that cash that you have in the offset account. You then apply and take out a new $100,000 loan that's separate to the $500,000 loan. You then use that $100,000 of proceeds from the loan and put it into your share brokerage account. This likely will be via a brand new offset account against that separate loan, but some lenders differ on what's possible and the way that they like to handle those settlement proceeds. You then invest that $100,000 into the same diversified share portfolio that you otherwise would have. So to sum up, debt recycling allows you to pay down your mortgage, invest, and then save tax and build wealth in the process. So whilst the decision to choose to debt recycle often is easy, implementing isn't quite as easy. And whilst there's loads of great resources online, hopefully including this video now, if you're still a little bit confused or just need a little bit more confidence, I've put together a debt recycling masterclass. This is an online course where I've taken my technical knowledge and practical experience with customers and put it into a simple way to debt recycle from A to Z. So if you'd like to check it out, head on over to edvest.com.au. There you can learn more about debt recycling, and you can also get access to the debt recycling calculator tab that I used earlier. As you saw, it only took a minute to complete, and I find customers are often surprised with the tax savings on offer. So that's debt recycling. If it applies to you, do yourself a favour and reach out or seek independent financial advice, or you can do your own research online, obviously. If it doesn't apply to you, it could in the future, so it could be worth making a mental note of the strategy. In any case, thanks so much for watching and the support.